Welcome to Mark Arnold's Finance. We're going to jump into it. We're going to talk about 3M. This company has been going down pretty massively recently, and in fact, the last couple years, it's just been on a downtrend. And investors, it's really hurting us. I do have this in my portfolio, and we're going to show my portfolio here in a second. And if you like that type of transparency, be sure to subscribe. I also provide diverse content, so I think there's something that you'll find that will be helpful to you. And of course, this is a two-way road. Anything you guys want me to make a video about, let me know or discuss. I'm happy to do so. So let's start by looking at 3M's stock chart, and let's look at the year-to-date performance. So far, it's been down 34.4% this year, and it took a recent nosedive, as you can see towards the end of this chart. And it's been painful to say the least. But is 3M cheap for a reason, or is this an incredible bargain opportunity? That's what I want to cover. And upon my research, I found a Seeking Alpha article that made actually a pretty decent case on why this stock isn't going to be a dud, and why, if you're invested in it, you should not be sad. So I want to cover this article. And like I said, we're going to look at my portfolio performance. So let's just bring that up here. Overall, on the top left, my stats, I am down 1.8% or $769. I want to take the attention to 3M, which is at the very bottom in the middle under industrials. This, I was only down about 14-15% for a while, and then it took a dive down to now 23.65%. It's incredible. It's a decent allocation. Anything in purple is the market allocation. So even when this hits a 0 for me, meaning that there's no red or green, it's just I'm kind of flat, not making profit or loss, it's probably closer to like a 6% of my portfolio. So definitely hurting me, and I have learned some lessons, but I am not being fearful with this stock, and I'm actually pretty hopeful, which I'm going to share with you guys. So let's start off with this. Sears once was the 6th largest company and is now bankrupt. AT&T has not delivered positive returns in 21 years. GE was the most valuable company on earth in the late 90s and is now down 72% off its highs. So everyone's asking, is 3M next? Is it going to be the next Sears, AT&T, or GE? Now this article kind of says no, it's not going to be the next dud. It's actually going to have a good future based on what this article covers. So let's dive into that. So of course 3M crashed 10% on August 27th on news that its legal maneuver to neutralize its earplugs liabilities was rejected by a federal judge. And of course 3M now is appealing that decision. They have a lot of legal overhang that could last for years. That's the biggest negative I see with 3M. Though it's predicted the final settlement will almost certainly be far below the worst case scenarios. And we're going to look at some statistics here in a little bit to see what's the probability that 3M will have a worst case scenario or really a best case scenario, and it's actually good news. So 3M remains strong in many areas, but isn't likely to return to fair value for quite some time, and that's mainly due to the legal challenges, which we know anything legal lasts many years. 3M is 38% historically undervalued, and it could deliver 17% annual returns within 5 years and 12.2% annual returns long term. So there's some positive outlook based on the research that was given in this article. So we're going to cover 3 reasons why 3M is not a value trap, unlike Sears, AT&T, and GE. So reason number 1 is 3M's crash is due to a perfect storm of short-term factors. And these are factors that a lot of companies are facing. So 3M at its high traded 28 times earnings. So at that time, it was priced as if nothing could go wrong. Now, it's 38% undervalued, and it's priced as if nothing will go right again. So it's like one extreme to the other. And right now, since it's priced like nothing will go right, if something goes right, it's going to be good news for you and I as an investor. So, of course, there's the rising recession risk, which just gets higher and higher every month. There's the general market negative market sentiment, which with a company like 3M that is having legal issues, they're going to really be negative on a stock like this. 3M's turnaround is complex with 2 spin-offs, and now they're trying for a third, I believe with its medical part of its business, which is obviously going through some hurdles. We'll talk a little bit about that. But so they're really trying to turn things around, but it is complex. There's several years of slow growth ahead with 3M, and that's very obvious due to the economy, due to this company's legal issues, so on and so forth. So the legal liability concerns, mainly with its earplug lawsuits, which involves thousands of military service personnel, is the main concern with this company and what people are focusing on, and is really bringing it down. So because of the legal issues, the stock market and investors, they hate long periods of uncertainty. Anytime you look at the stock market when it goes down, it's usually due to uncertainty. You look at the pandemic, there was uncertainty and it crashed. But as soon as people had some certainty, right, the government stepped in and provided a lot of aid, it shot up. So uncertainty is the worst thing for the market. And so with 3M, that's what's really causing some pain. Due to the legal issues, 3M is expected to have low dividend growth, about 1%, and its share buybacks are expected to remain low, and that's because they're wanting to build up a cash position in order to, have enough to cover all these legal issues depending on what the end results are. So I want to show you this chart of verdicts. Now this is of the 10 largest product liability awards by U.S. jurors. Most were overturned or the payouts to plaintiffs were cut drastically. So you'll see on the very right the verdicts. The very left is the case against which company and the initial award versus what was the end verdict result. So a lot of these were reversed or reduced. You'll see there with Philip Morris 99.9%. You'll see with Takeda Pharmaceutical 99.6%. General Motors 75% reduced. There's a big trend here where they settle. You'll see the Johnson Cart 1.02 billion was the expected award, and it settled for 250,000. So basically, through statistics of history, this article is pointing out that it's very unlikely the worst case scenario is going to happen with 3M, and this is proof to show that throughout history, the final verdict is a fraction of what they're originally going for. So that's positive for 3M, and something that I think is something to keep in mind. So that was the first kind of argument on why this is not a value trap. It's due to the market, the conditions, the economy that we're in right now, just a perfect storm kind of. Number 2 reason why it's not a value trap is the investment thesis with 3M remains intact. So going through this, there was some really good information. First of all, let's look at this. Its credit rating. It has great credit rating. So with S&P, it's an A+. With Moody's, it's an A1 or an A plus equivalent. With so the consensus is an A+ with a stable outlook. So that's this is great to see, and provides with good ratings. It just means there's a lower risk of default or bankruptcy. So that's something to keep in mind. And researching more, it says you have a 1 in 167 chance, a 1 in 167 chance of losing all your money buying 3M today. So that also helps solidify that this company is still strong and has very low risks as far as being one of those companies that went bankrupt or has been a dud for a very long time. 3M's balance sheet is strong and expected to get stronger over time. Growth rate is modest through 2026, but net debt is expected to fall rapidly, even without the medical spinoff occurring. So if we look at this chart, this is just showing that through 2026, it goes from top to bottom. Its net debt there on the right gets less and less and then non-existent because their cash is getting higher and higher, despite their debt remaining at pretty much the same levels or even increasing slightly. So that's a good sign. Strong cash position means the net debt goes down, which is amazing. That's a great thing to see as an investor. They also have a strong bond profile. The bond market is pricing in a 1.14% 30-year default risk, extremely low, which is consistent with an A credit rating company. So those two match up, which just adds more strength to this argument that it's not a value trap. Profitability-wise, if we look at this snip, we will see here that profitability is in the top 10% of its peers. So it kind of has this GF score chart on the top, which scored it a 90 out of 100, which confirms its industry-leading fundamental quality. And then Wall Street had its own rating below, which was that 10%, top 10% of its peers. So it has great ratings profitability-wise, which is fantastic. Its margins are expected to rebound and hit new highs by 2026. Margins are important. Return on capital is also very important, and it's expected for 3M to rise to 41% by 2026, which is 3 times that of its peers and 3 times better than the S&P 500. So again, you can look at something at face value, the news, what people are saying, but when you dive into things, so far 3M is looking pretty attractive. Solid cash flow conversion of 96%, so free cash flow is what pays the dividend. Right now, 3M has a 60% payout ratio and a dividend yield of 5.11%. So 5.11 is an excellent dividend, right? That's very attractive. And the payout ratio, I like to see my companies below 50%. This is at 60%, but in all honesty, it's not bad. It's not going to put this dividend at risk. There are bad companies out there that their payout ratio is above 100%. So I think 3M will be able to sustain their dividend and grow at those low 1% rates for at least a few years before they increase it. It's expected maybe after 2 or 3 years I was reading, it's expected to go up to a 3% raise. So low dividend growth, but that's okay. They're putting money aside for those lawsuits, which is good. They're preparing for those. And we're still getting a good dividend without the risk of it having to be cut is what it's looking like. So that's the number 2 reason, is their fundamentals remain intact, which is showing that it's not a value trap. So the third reason that it's not a value trap is it's a great company at an unbelievable price. So for 20 years, investors have paid between an 18.5 to 20.5 times earnings for 3M, and now it's at an 11.8 times earnings. So it's been cut in half, right? The price of this stock, which is incredible. So they're saying throughout the 20-year history, people were paying between that 18.5 to 20.5, and now you'll be paying an 11.8 times earnings. So that's great. Has a 9.2 times cash adjusted earnings versus the 12.7 historical cash adjusted earnings, which again, very inexpensive. The discount price target. So right now, its stock price is about in the 116 range. Its discounted price target, meaning more of the low end, is $147 per share, where the fair value target, which they're saying will be harder to reach but eventually will, is $183 per share. So there is a case to say it can go up 65% within the next 12 months, and that's justified by its fundamentals. Of course, that is more of a long shot, but it's possible. So I want to say this also about 3M being a great company. I feel they have a wide moat. They have so many products. In fact, some people say they have too many, but you and I and businesses out there use 3M products more than we probably realize. You go into Home Depot, you're going to see a ton of 3M products. You look around your house, a lot of the things you use, I just bought a couch, so those little floor protectors, 3M. I've actually witnessed going through restaurants and businesses seeing products that have 3M on them. So they really do, I feel, have a wide moat and good quality products that, we're going to be buying for a long time to come. I don't think this company is going anywhere. So there are some risks that you have to consider, of course. The balance sheet weakness. So there's a chance that the balance sheet can be weakened, which means its financials are weakened, which means it could put dividends at risk and all this stuff. Also, the legal liabilities can be more towards the high end. And then it can have a growth outlook that falls, right? We've seen a lot of cuts in companies' outlooks. So if 3M over the next year or two puts some pretty drastic falls on its outlook, that can also be a risk. But the balance sheet weakness, the legal liability, and the growth outlook falling is all very unlikely according to the research in this article. And so with it being a huge value right now, if you're a 3M holder, this is my thoughts. If it's a huge part allocation of your portfolio, it's going to be risky. I don't think you should ever put more than 10% in one company. I have a little over 12% in Microsoft, but if you go a little bit over that, that's fine. But with 3M, I feel if it's a big part of your portfolio, that's definitely risky. But if you're in a decent range, I'd say 8% or less, just average down and take this research that I did and shared with you guys, and hopefully that helps bring a little bit of peace to you, because I know seeing that 3M deep in the red was definitely, it's not fun to look at. And so I think do your own research too, look at the bear and the bull cases, but I do think 3M is still a very strong company, and I do think that after 2 to 3 years, it will start to recover, but you just have to be patient in the meantime, because those legal things last forever, and that's what people are going to focus on. But they are expected to have growth. They have strong, financials overall. They have a few weak points, but they have strong financials overall. Just everything we went over, I think solidifies that I am still happy with holding 3M. Now, it is a decent part of my portfolio, more than I'm comfortable with. I think once it gets out of the red and back into the green, it'll be closer to a 6% allocation, like I mentioned. So when and if this company gets into the green, I will probably cut it in half. I will take half of it and sell it, take those profits and put them somewhere else. That's just how I feel with 3M. I feel it's good to have a small allocation and exposure to 3M, because I think it is a solid company with a wide moat and future growth. But there's probably some better options out there once this company gets into the green, where you probably want to scoop up some of those profits and put them elsewhere. So those are my thoughts on 3M. This is the research I did based on the article with Seeking Alpha. And so let me know what you think. I know there's probably a lot of people invested in 3M because of that attractive dividend, and we're all probably in the red. And so let me know what you plan on doing, if you agree that this is not a value trap, or if you think it is and why. I'd love to hear your outlook on it. And with that said, thank you guys so much for joining me. Be sure to subscribe, and we'll see you next time on Mark Arnold's Finance.